already as well. So I jumped into chapter number 13, marginal costing. Now, this is another technique. There you have already learned absorption costing technique, activity-based costing technique, and this is marginal costing. Marginal costing is also known as variable cost. What does it known as? Variable cost. Yes, marginal costing is variable cost. Absorption costing is full cost. Full cost, because we take the fixed element in it, but we don't take the fixed element into the marginal costing. Yeah. You already know what is a contribution. Sales less variable cost is known as contribution. Of that, you take your fixed cost, you get profit for the year. There's something also known as yeah, I was saying absorption costing is known as full cost, marginal costing is known as variable cost. But a couple of more: period cost and product cost. Period cost, over the period of time when you charge a cost, that is known as period cost. Yeah, that is known as your period cost. over the um, over the year. You don't include into the product. For example, rent, rates, insurance of the building, even the salaries, and so on, so on. These are your what do you call it? Period cost. But what is a product cost? When you include fixed costs into the product, in absorption costing, that's what we do. Rent and rates and everything, all full cost we include, that is known as product cost. So period cost we charge over the period, not into the product. And product cost, when we charge fixed costs into the product as well, like in absorption costing. That's your period and product cost. And marginal contribution approach, you already know, very simple but important, which is your, what do you call it, sales less variable cost is your contribution. Sales less variable cost is your contribution. Of that, when you take away fixed cost, FC, you get profit for the year. That is the marginal costing approach. Let's keep going over this chapter. Okay, we have a very simple question and simple answer. Activity 1. I will do J for you. You're going to do K for me. L, we're going to ignore. Okay, selling price given, material, labor, variable. All these are variable cost. Even variable overhead is all your variable cost. Fixed overhead is your FC, fixed cost is straight. What is the contribution? Sales less all my variable cost, isn't it? This is ignored. So I should get my answer. Taking the calculator on screen for you people. I am doing J for you. You people, please do K for me. 10 is the selling price, minus 3 minus 1 minus 0.25 minus 0.75. I got £5. 5.00. 5.00 is the contribution per unit, right? Sales less VC. These are all my VC. Okay with that? For K, I'm giving you less than a minute. 1 minute. Give me the contribution for K. Sales 5 minus variable cost. I got one answer so far. Give me more answer. Thank you. Okay, Agnieszka and Ashraf, both of you should are correct. I hope so. 0.75. If anybody gets any different answer, we can argue. But this is the answer. Thank you all as well. Simple, yeah? That's your contribution. But you know, there's something about marginal costing approach which is good. It doesn't count the fixed cost, doesn't it? Fixed cost is taken away. So fixed cost is a relevant cost. Fixed cost is irrelevant. But when you take a decision, fixed cost doesn't make any difference. Like whether to continue a product, whether to cut the product producing, fixed cost gonna occur anyway. Whether increasing the product, decreasing the product, that's not a problem. It's fading. My hairs are fading. I don't know what is happening. Okay, so don't worry. So I was saying, fixed cost is irrelevant, but marginal costing, variable cost, which is relevant, and the more it gives you contribution, the better. The company is making profit. And listen to me, please, everybody, carefully. You have 3 components: product A, B, C, D, E, F, even more than that. Any product that is giving you contribution, you should keep producing it. I repeat, the product which gives you contribution, you should not stop it. Maybe the product is not profitable because after deducting fixed costs, maybe the product is not profitable. But if it gives you contribution, you should keep producing it. Why? Because fixed costs going to occur anyway, whether you produce that product or not. You should have to pay the fixed cost of rent of the building and salary of the fixed employees here. But if you produce that product which is giving you loss but contribution, You can generate extra contribution, extra money. Well, let's put some facts and figure into throughout working with the illustration. Illustration number one, absorption costing and marginal costing. This example is giving you absorption and marginal both. Yeah. In absorption, we include the fixed cost. That's it. The cost per unit. In marginal, we don't include the fixed cost. We take the variable cost into the cost per unit. Yeah. Okay. The more we progress, the more I will be talking, and still my head is fading. Oh my gosh. Don't worry. Graham Associates produce just one product in their factory. The factory has two production departments and assembly. No, no, no. Hold on. Two production departments. One is assembly and one is packaging. Okay. The two production department. The anticipated production for the next month is 50,000 for the month of March. An expected cost, material cost given, labor. 3 hours needed in assembly, each gonna take you £8. 8 times 3 equals to 24. We should do that type of working straight away, because now we are into the last few classes, so I should go exam style. You ask for extra paper from the invigilator before you start your exam, and on that paper you need to do your workings. Yeah, you must do the workings. Don't trust on the calculator always. Like, I'm doing my all workings on the calculator. Yeah, it might save little time, like you're doing everything on calculator, but when you write it down, it's evidence. You can go back and check your work. 1 hour for packaging, 6. So for packaging is £6 per hour. Assembly variable cost is 240,000. Assembly fixed cost, so we're going to charge this fixed cost into absorption, including variable, but variable we're going to charge into the marginal only. So just keep it in your head, then I will show you the working. Packaging variable and fixed cost given, over absorbed on the basis of labor hours. Okay, not a problem. We'll start by calculating the cost of each unit, people. Cost of each unit. So you're checking what is the cost per unit under absorption costing, then under marginal costing as well. Look at this. So two department, assembly and packaging column, way two department, and here's the detail, you can say, and little workings. This is working column. Overheads, variable and fixed, 360 for assembly. Let me show you 360. How did they get it? Assembly 240 plus fixed 120. That makes 360, right? 360. Okay, that's my 360,000. So those with the packaging. When you add 140,000, that's your 140,000. Now, that's my total cost, isn't it? Fixed and variable, all the costs. Yeah. What are we doing here? We're getting over absorption rate. We are trying to get over absorption rate. Under absorption costing, then you're going to do under marginal costing. So our total overhead is 360,000. Both VC and here they said VC and FC given here. That's all right. We're following absorption costing. But they said OAR is based on labor hours. So how many labor hours are there you need to calculate? 50,000 is your production plan. And to produce each unit of assembly, how many hours needed? 3 hours. Yeah, thank you. Thank you. I would have given you the answer anyway, but thank you, Agnieszka, for your writing. That means you're very sharp. Thank you. Good. 3 hours. So 3 times by 50,000, 150,000 hours needed to produce all the assembly. Then we can find out 360,000 divided by 150 equals to 2.40 is your OAR, overhead absorption rate. This is all repetition from last few chapters. Under labor hour. And packaging needs 1 hour, 50,000. You need 50,000 hours. 140,000 is overhead divided by OH divided by labor hour we are doing, and we're getting over absorption rate per labor hour, not per unit, isn't it? Not per unit. I'll show you how to get the per unit. Now, people, after doing the over absorption rate, we are checking what is the cost per unit under absorption costing, AC. Material cost, if you remember, is given per unit, £20. I'm taking you at the top and highlighting it for you. £20 is my material cost. Hope it makes sense. And labor, I should circle. Assembly is 24 and packaging is 6 in it. Assembly is 24 and packaging is 6, because assembly 3 hours needed and packaging 1 hour needed. For overhead is based on labor hours. That's why in assembly you need 3 hours, but what is the over absorption rate per labor hour is 2.4, which we have worked it out. 2.4 per labor hour. But what is per unit? Per unit is 7.20. Very often I have seen students, they tend to take 2.4 here as well. Don't do that mistake. 2.4 is per labor hour, but to produce 1 unit of into the assembly department to produce 1 unit of item, you need 3 labor hours. So 2.4 times by 3, you get 7.2. And in packaging department, you need 1 hour, 2.8. And yeah, that's your cost, total cost, material cost, labor cost, more labor cost. Then these two are your OH, overhead, which is basically fixed cost, but a variable is there as well. Overhead can be variable, fixed, both. Yeah. Sometimes students tend to think overhead is only fixed, not actually. Overhead can be variable, but mostly fixed. Yeah, fixed and variable too. So this is under absorption costing. Your cost for 1 unit, let's assume we're producing this pen, cost is £60. Under marginal costing, we don't take into account the fixed cost. Yeah. So look at this. We have taken variable overheads, and then we're going to do the cost per unit. I can do another quick, easy way. Let me show you. That is the basically way of doing it, but this BPP book has done little longer way. 40,000, if you divide it by 50,000 units, what is the cost per unit? 4.8, isn't it? Just keep it in your head. I will prove this 4.8 in a minute. Yeah, they're going a little longer way, but fine. You are learning the OAR again. So 240,000 divided by 150,000 of the labor hours, you get 1.6 per labor hour. But what is the per unit? 1.6, 1.6 times by 3 hours needed, isn't it? That's your 4.8 on the screen calculator. I hope it makes sense. Yeah, let me show you here. Like material labor is just copy paste from the top, nothing much. But overhead, we said 4.8. How? Because 1.6 was over absorption rate and a variable cost or marginal costing, and you need 3 hours, so you get 4.8. And 1 hour needed to produce into the packaging departments, which is £2. 2. If you again ask me, Ilyas, how did you calculate through the using the units? We can do this too as well. 100,000 divided by 50,000 units. So cost per overhead, variable overhead per unit is 2. That's how you get your 2. Yeah. Or 240,000 divided by 50,000, if you do, you still get 4.8. So different ways of doing it. Well, that's great. Activity 2. I think I should test your knowledge. Uh, I will read it, even we're going to do it together. A factory produces a single product with the following budgeted costs. Yeah. Direct material, direct labor, variable overhead, and fixed overhead. Fixed overhead total given. Over is absorbed on the basis of machine hour. It is estimated that the next accounting machine hour will be 100,000. It's better to do our OAR straight, whether needed or not. OAR is overhead over machine hour. Yeah, and so what is the overhead? 340,000 over 100,000. I'm going to get 3.4. I do very less mental maths, but if it's very easy, I don't mind. Each unit requires 2 machine hours. 2 machine hours requires means if you multiply by 2, so 6.8 is your overhead per unit. Okay, overhead absorption, fixed cost basically. Now, people, most of the work I actually done it for you. Let me do it for you. The other one maybe you do. Material 3.4 per unit. People do remember 3.4. Direct labor again per unit. They said it. Single product means per unit, so 6.8. I just need calculation from you. Variable overhead is 1.2. Total variable, what is the total variable cost? Can someone give me the answer? 6.4 plus 6, no, sorry, 3.4 plus 6.8 plus 1.2. What is that? I'm using my big calculator. 4 plus 6.8 plus 1.2. 11.4. Thank you, Ashraf and Ala. 11.4. I got the same answer here. Thank you, Pavla. Thank you. Those of you who have worked, write it back to me. Yeah, better. Now, what is the fixed overhead? Fixed overhead. How much we worked it out? Tell me. How much is the fixed cost, which is we have worked it out? This is our working. Yeah, fixed cost, fixed overhead. Fixed cost, come on, 6.8. 6.80. Yeah, so 11.4 plus 6.8 is my 18.2. 18.2 is the cost under absorption costing. Cost per unit. They said it per unit, but I'm saying again. So these are all my variable cost. 6.8 is my fixed cost. Hope it makes sense and you understood it. We're going to check the answer in a minute, but before that, marginal costing. Marginal costing, we done the answer already. Material we done it, labor on done it, variable we done it, and marginal cost means VC, variable cost, and that is 11.4. That is 11.4, isn't it? This BPP book should have given us B first, B as an A, then A as a B, right? Hope it makes sense. Let's check the answer. I've got this answer before. 18.2, good, well done. And this one is nothing much. Activity 3, I want you people to do. I want you people to do. Give me the total marginal costing. Just give me that figure. Already it's given and this should be divided with the number. Okay, this is the question in front of you. Marginal costing you got to do and absorption costing you got to do. I'm giving you 2 minutes, 1 minute for question and 1 minute for writing back to me. 2 minutes. I'm doing along with you people as well. Okay, it's on unit basis. Okay, I got the answer for A already. Yeah, you should get as well. It takes, if you know it, 30 seconds. I got only one answer from Ashraf. Okay. And Omid. So both of them are saying 33.5. I do agree with them. If anybody disagree, you can talk to me. We can go ahead. Do the absorption costing. I'll do as well. It's just one click away. And I got the answer. And I got the answer. And that's correct answer, 43.5. You know, it's nothing but copy paste. 12 we have copied here, 13.5 we have copied there, and there was a maybe 88,000 divided by 11,000, wasn't it? Yeah, 8. So that makes your 33.5, and that is your 33.5 here, and people found 10 there. How did you found 10 there? And thus they found 43.5. How did you find the 10? Who gives me that answer? 110,000 divided by 11,000. Yeah, you get 10. That's your fixed cost per unit. Oh, that's the unit I was showing you the other time. Thank you, Agnieszka, for your workings and writing back to me. Yeah, easy, in it. Very nice and interesting. And today is going to be, I hope, so far relaxed, and later on might be more work we're going to do. But it has an effect on the profit, absorption costing and marginal costing. You are allowed to choose either of it, both of these costing method, even activity-based costing. Anything you want to choose, you can choose it for your accounting purpose. These are internal accounting, management reporting purposes. But it depends on the nature and the size of the business, which method, absorption or marginal, you're going to choose. In the long run, it's going to give you same answer. In the long run, they're saying here, in the long run, it's going to give you same result, but short term, over the months, if you follow absorption and marginal costing, your profit statement will be different. Your profit will be different. This is because of closing inventories. Closing inventory. Closing inventory. Why? Because you can write it down, fixed cost tied up in closing inventory. Fixed cost tied up. I will show you and prove it. Okay, I want to give you, before I start this illustration, this is a long illustration. If, write it down. Oh, how shall I? If the increase, this is an increase, a plus. Closing inventory, if closing inventory goes up, AC profit goes up. Okay, absorption costing profit will be higher. If your closing inventory is higher, absorption costing profit is higher. Then if it's the other way around, if closing in means inventory is lower, your absorption costing profit is lower, down. If there is no opening and closing inventory, both AC equals to MC. Yeah, absorption costing is equals to marginal costing. So these three rules you should keep in your head, which you're going to prove. Yeah, write it down, please. I hope you have written it down. If closing inventory is higher, absorption costing profit higher. If closing inventory is lower, absorption costing profit would be lower. If there is no opening and closing inventory, both under absorption and marginal costing profit would be same. Let's do some works here. Returning to Graham Associates, they're saying they're going to produce over the month of March, April, and May 50,000 units. This is, we already know 20, this and this, um, fixed and variable cost from our last example. But look at this, March, April, and May. Sales are different. You produced 50, you sold 50, so there was no opening and closing inventory, wasn't it? In the month of March, AC and MC is same. Month of April, you produced 50, but you sold 45. How much is left? 5, yeah? 5 is left into the inventory. That is your closing inventory. Do remember that one. Isn't it the closing inventory for April is the opening inventory for May? Yes, answer is yes. So in May, what is happening? You produced 50 and sold 52. At first, you can say, how is this possible? Can we sell more than the units we produced? The answer is you should not forget your opening inventory. In the month of May, you have an opening inventory, which is coming from April 5, plus you produced production 50, less sold is 52. How much is left? 5 plus 50 you will produce minus 52, 3. 3 is your remaining close inventory. I hope you understood what I did here. Yeah, closing inventory, found it. So look at this, opening inventory for the month of May is 5, closing inventory from the month of May is 3. That means the inventory has gone down. Inventory has gone down. The first month of March is equal. Month of April, inventory has gone up. So absorption costing profit will be up. A month of May, closing inventory has gone down compared to opening inventory. That's what we meant to say, which is down by 2,000 units. So your absorption costing profit will be lower. Let's prove it. Let's do it then. The working we have done already, even they're bringing it down here. Cost, total cost given. Selling price is the new information, which we got it. Let's do the information here. 50,000 units we are selling at the rate of 70 each. So that is our selling price, 3,500. Thousands are there. Opening inventory for the month of March is nothing, 0. Cost of production, we produce 50,000 units under absorption costing 60 each. So that's my production cost. And that's the total of it. And that's the total yet again. There's no closing inventory either, 0 closing inventory. So cost of sales, we're taking away from the sales to get profit for the year. Yep. Look at this. That's under absorption costing. And under marginal costing, your sales going to be copy paste because the same price sales. But opening inventory is nil, 0 because there's none. Cost of production will be different. 50,000 would be costed at marginal costing, variable cost, isn't it? Which is 56.8 less. You can ignore this one. I don't like that way of presenting here, but that's your cost of production. There's no closing inventory, so there's all of it is your cost of sales. Yeah, sales less cost of sales, or variable cost of sales, we call it. Yes, under marginal costing, we call it variable cost of sales. We get contribution 660. Off that contribution, we take a fixed cost, which is this. There are a couple of fixed costs taken away. You get profit for the year. Look at this profit. Absorption and marginal, both of these are 500 in it. There's no difference, because there's no opening and closing inventory. Yeah. But next month of April, we sold 45,000. We produced 50,000. That means into the closing inventory 5,000. Let's do it then. 45,000 at the rate of 70. We got a selling price. Opening inventory is still none. Cost of production 50,000 we produced at the rate of 60, which is 3,000. And ignore that one, as I said. Closing inventory is a minus from the cost of sales. So please, I want to spend at least 1 minute here, one valuable minute. Each minute of your lesson is important, but this 1 minute is also important, very important. What does the closing inventory do into the income statement or SPL or into the cost of sales? What does it do? It makes your cost, yes, down. It makes your cost down. That concept gonna help you in many different places of accounting. Closing inventory makes my cost down. If cost goes down, what happens with the profit? Profit goes up, isn't it? So these two thing, one thing basically, but leads you to the two results. Closing inventory, what does it do? It makes your cost down. Cost, opening inventory, cost of production, these are your part of cost. But closing inventory makes it down. So if your cost goes down, your profit goes up. So my profit is 450 here, but under marginal costing, sales as it is, opening inventory none, cost of production is given. I mean, at the rate of this. Closing inventory, look at this. My closing inventory is different now. Look at this, the closing inventory here was 300 in absorption, and there is 284. So closing inventory is less in marginal costing, isn't it? So marginal costing profit will be less, isn't it? That's the idea, okay? So cost of sales is much less. It's less by, I don't know, I do know, 300 minus 284 is less by 16 pound. Yeah, the difference between 300 and 284 is 16 pound. I will show you what does this 60 happens. So you get a cost of sales, which take away from sales to get contribution less fixed cost, you get profit for the year. Now the profit for the year, profit under marginal absorption costing is 450 and under marginal costing is 438. How much is the difference? 16, isn't it? 16 pound profit less. Why? Because of the closing inventory. Because of this closing inventory. Yeah, closing inventory is less. Why? Because in this closing inventory, FC, fixed cost, not included. Fixed cost is not included into this closing inventory. And how much is this valued? 60. And how much is this valued? 56.8. So taking the calculation, so 60 minus 56.8, which is 3.2 is less. This closing inventory is 3.2. That 3.2 is basically your fixed cost. That 3.2 is your fixed cost, isn't it? Yeah, there you go. This is the explanation. 16 pound is the profit difference in the profit. How did they get it? Their fixed cost 120,000 and 40,000 was the fixed cost. You divided by 50,000 units. Fixed cost per unit is 3.2, which was not included under the marginal costing per, when you do the inventory. That's 5,000 your closing inventory times by fixed cost. That's the 16,000. That's how we do reconciliation. Sometimes we meant to do reconciliation. I hope it makes sense. Let's do May, similar work. And in May, I have worked out, I would like to repeat the work here because it's a live class, but when it will be recorded, you can check it out one more time. Again and again, as much as 5 was my opening inventory, 5,000 plus production is 50,000. For the month of May, we are doing May. Less sold. Sold is 52. How much is remaining? 5 plus 50 plus minus 52. 3 is the remaining. 3,000 is the remaining closing inventory. Closing inventory. That's your 3,000. How did you get this 3,000? Student might ask, how do you get this 3,000? The working, I just did double for you one more time. That's your closing inventory, okay? But compared to opening, closing is going down. You don't need to do anything. You just follow the pro forma. The profit or loss will be automatically anyway. But because you know if closing inventory goes up, absorption costing goes up, profit. If closing inventory goes down, absorption costing profit go down. This time absorption costing profit gonna go down. Whether it goes down or not, let's see it. 52,000 items at the rate of 70. This is the selling price. Opening inventory is there this month, 5,000 at the rate of 60. So you get a figure. Cost of production 50,000 at 60. You get a figure. So now I like this way. 300 and 3,000 added up together, you get 3,300, don't you? And then closing inventory is 3,000, which you worked it out at the rate of 60. Take away from the 3,300. You get your cost of goods sold. This box we call it COGS, cost of goods sold. Taken away from the sales to get your profit for the year. And the marginal costing sales is as it is copy paste. Opening inventory will be valued at this price plus cost of production 50,000 valued at this price added up together 3,124. Taking away closing inventory 3,000 items. Yeah. And you get a cost of variable cost of production. We call it variable cost of deduction, because these are all variable costs. Taken away from the sales, you get contribution. Take a fixed cost. This is your fixed cost. You get profit. Now look at this. Profit is higher under marginal costing. That's again because higher by 6.4 or 6,400. And that is again because of fixed cost. How many, what was the increase? 5,000 was opening, closing was 3,000, wasn't it? So there is a decrease, sorry, no increase, decrease by 2,000 units. And decrease by 2,000 times by fixed cost per unit. Fixed cost is tied up into the closing inventory. 3.2, that's your 6,400. Yep, that's so good and lovely. People, you have an activity in front of you. Sanctuary Catering. They're producing and selling two products, standard and vegetarian. Meals prepared and sold given. Hours given. Sales revenue given. Material given. Direct labor variable. Even fixed cost given. This is such a simple stuff, and year two, three kids can do is dividing and multiplying. I want you people to do it right now. Take a picture of it or screenshot. There's the question in front of you. Take a picture or screenshot, or if you have the book, fantastic. I hope you have taken it. Do the answer here. I want to give you 7 minutes, I think. Yeah. 4 minutes you can do it, and 3 minutes you can transfer. 8 minutes. Okay, 8 minutes given. So your time started. Okay, where is my TikTok? 8 minutes given. Do that work right now, please. And for me, it's a little rest time here. So keep doing it. I got two answers from Amit and Ashraf, and it looks like identical, which is great. One more minute, yeah? I said 7 minutes is better. Let other people do some work and let them send back to me. Okay, it's time to reveal the answer. I'm putting my TikTok at the bottom. It's just dividing and multiplying, nothing but that. As I said, if you divide this with your mill, you get the first answer. Divide with your mill and get it, and divide and you get the answer, don't you? Unbelievable. That's the answer. You don't need to do this one. There's not much needed here. And even this, uh, the fixed cost, or fixed cost, you don't, nothing to do, divide and multiply 212. The total fixed cost, whatever is the contribution, from contribution take the fixed cost, you should get profit, shouldn't you? Let's check it out. Activity 3, yeah, oh, yeah, done it, yeah, it's good. But this is the one, as I said, divide and get the answer, divide, get the answer, get the answer, don't you? Yeah. Oh, that was sales, sorry, this is the sales here. um and yeah, this is this with that. How do you calculate contribution per unit? Sales less variable cost, Agnieszka. You calculate sales less variable cost, don't you? You're welcome. You get the selling cost per unit. Once you get the selling cost, X figure, I don't know, whatever is the figure, these are all your variable costs. Take away from the sales to get the contribution, don't you? Once you get the contribution per, I don't know how much, maybe £2, and get the volume of the units. There's a volume given at the top here, 130,000 mil. Let me show you here because they've done it. Excuse me. Sales given, then variable costs you got a. So from this, you take away all these three items from 8, you're left with 4.4, 40 pence. And 130,000 units you're going to sell. 40 pence times by 130,000, you get 50,000, 52,000 is the contribution. Likewise, 200,000. Total contribution to 50,000. Take away 212, you get profit for the year. Hope it makes sense. Moving on, and we literally finished the chapter. There are some advantages and disadvantages. Read at your own time. From my side, um, absorption costing is arbitrary, but our marginal costing is relevant costing. It helps in terms of decision making because fixed cost is not taken into account in the cost per unit. But absorption costing good side is it takes full cost, so all costs are covered, and generally in the long run both of these gives you the same profit, not a big problem. Same type of question, I'm ignoring activity number 5. It's the same and similar, not a big stuff, little lengthy question, but getting, we have done a cost per unit under absorption costing, marginal costing, and profit per unit.